Hey, Bowtie Nation, Joseph Hogue here. Thank you for joining me for another one of these Beer Money Sundays. An informal live stream I do every Sunday. Love connecting with you, all you out there in the nation, every week. So I've got mine. I hope you got yours wherever you're at in the nation. Let me know where you're coming from the nation. I already see a bunch of longtime members. Frank from Poland there. Max, thanks for joining us. Thanks for being here. Again, just love doing these. Chance to take off the tie, get a little informal, and just talk to you about a topic, each week, and kind of general Q&A about the markets and where we see everything going. So really cool, kind of a contrarian kind of idea for you today. I know we love to talk about investing in the markets and kind of timing and strategy here on the channel. But one thing that gets less attention than I think it should is the fact that that you really don't need to time the market. I mean, and sometimes, for 90% of the investors out there, it's best to just a simple stock investing strategy that I'll share with you today. But we love to talk about stocks in the market, and we can talk about prospects for a crash. But one very simple truth that every investor must understand is trying to time the market by getting in and out ahead of a crash can just cost just as much as actually just sitting through that crash. Okay, one of my favorite quotes here by Peter Lynch, one of the all-time best investors out there, says, far more money has been lost by investors preparing for corrections or trying to anticipate those corrections, those crashes, than has been lost in the corrections themselves. And it's so true, especially for anyone that's been in the market for as long as I have, and been investing for more than 20 years, been a professional analyst for 10 plus years. And you look back and just my own investing, not necessarily the analysis and everything that I've done for clients, but just looking back at your own investing and seeing, okay, you know what, all these strategies trying to time the market, trying to get out before a crash or trying to prepare for a crash, a lot of times actually ends up losing you more money than what you would have actually lost in the crash and just sat through it. So actually going to go through today, going to share some data with you on how much you would have with the returns for investing different time periods, in time periods before, after, and during the crashes in history, and show you that, a simple strategy that we'll talk about later on in the video might just be easier and a hell of a lot less stress on your life and on your investing. So we're gonna get into that. First, I do want to invite you to download a free report that I'm doing with the Motley Fool. My biggest 5 stocks in my own portfolio. Okay, these are the 5 stocks that I'm really planning on taking my portfolio to that next level over the next 10 years, 10, 15, even 20 years. I mean, these are the biggest themes, the biggest growth themes over the next 10 years. Things like AI, things like digitization, things like self-driving and electric vehicles, things like that. And 5 of the stocks that actually benefit from multiple trends. Okay, so we're not talking about just one stock that benefits from AI or one stock that benefits from e-commerce or something like that. We're talking about stocks that benefit from multiple trends, from many of these long-term trends. And I really think can go much higher. So I actually put that together with the Motley Fool. It's a free report, no obligation, totally free, and really just a way that to support the channel. Okay, if you click through the link that I pinned in the chat or in the video description below, you can you sign up and get that free report. Motley Fool is going to send you some emails, of course, but you're under no obligation. You don't have to pay for anything. And it's actually a good service. I actually do use the stock advisor on the Motley Fool. I know a lot of investors are on the fence or not a fan of the service, but I like the service as just a way to kind of get a heads up on some of those trends and some of those stocks that they're watching. But go ahead and click through there. Use the link that I pinned in the chat or in the video description below. Check that out and get those. See what the 5 top stocks in my portfolio are. We're gonna get started here though, because I want to cover this, this topic because I think it is so important, especially for a lot of investors out there that have seen a lot of the market this year and think they have to pick stocks. Maybe they're scared or a little frightened of a market top because stocks are undeniably expensive. And, while I don't think we're going to get a crash this year, a stock market crash, we could easily get another correction of 5-10% or even more. And eventually we're going to get another crash. It just happens. It's just a way the markets work on that cycle of enthusiasm, exuberance, and then a crash. So we will eventually get a crash, but that doesn't necessarily mean that you have to time it. You have to get in or out before a crash, and that it might be the best strategy for you. So I want to cover that, and then we'll cover questions and answers at the end of towards the end of the video. So make sure if you have any questions, then go ahead and save them to the Q&A section, and we'll talk about that. If you didn't catch them, last week's videos, actually Wednesday shared 5 forever stocks that I'm holding, and it's actually a really great addition to that list that I share, in the link there with that the Motley Fool free report that I did, because these 10 stocks, these are really the ones that are going to benefit the most from those long-term themes that I'm watching for my own portfolio. Talked about Coinbase stock yesterday, a really highly requested video. A lot of people talking about Coinbase stock, whether they should invest, whether they should hold on. It's down, I think, something like 20 or 30% from its, maybe 15-20% from its IPO or from its direct listing. Excuse me, was not an IPO. It was a direct listing earlier this year. And, I generally love these picks and shovels kinds of stocks, so these ideas, especially the other exchanges. I've held shares of CME Group, ticker CME, for a very long time because I love that picks and shovels idea on investing, on the markets and the exchange runners. But, shared kind of a simple truth for Coinbase on Friday, in our Friday video, that has me not buying the shares, actually. I'm, direct investing in Bitcoin as well as Ethereum. I think there is some long-term upside there. I really like those as investments, but Coinbase, not so much. Coinbase is kind of a win-lose situation, whereas the cryptos themselves are more of a win-win if you think about it in the terms that we talked about in that video. So check that out. Next week we got some more videos coming up. Great videos on one of them, a Bitcoin strategy that I've actually just started using that is really kind of the best win-win situation you get with investing, right? A strategy I'm using with Bitcoin right now really has me all in on my Bitcoin investment. And I don't care if the price goes down or not, because if the price goes down actually this year, then I'll actually make more money in the long run than I will otherwise. And that's not just because I'll be able to buy in at a lower price. That is this other loophole tax strategy that you can use with Bitcoin because of the way it's defined by the government. So be sure to check out that video as well as the other ones we got coming up. But now I want to get into our topic for the week here, because if you've been following the channel, all you out there in the nation have been following the daily Bowtie Hour market newsletter and everything, that I think that stocks are undeniably expensive. And, the big news over the weekend was that the group of 7 countries, G7 countries, largest economies in the world, France, England, Germany, US, all that, agreed on a 15% low rate, at least a 15% corporate tax rate. And that's building up to the G20 meeting, which is in July, right? So the idea was that, everybody's going to agree on at least 15% corporate income tax. That's going to get away from some of these tax shelter jurisdictions like Ireland that has a 12.5% tax that really draws companies there and kind of underreports or underrepresents in the tax structure. And so a lot of people are worried about that. Now, honestly, it's more of a headline. It's more of news than anything. It's going to take forever for them to agree on anything, and then each country has to, actually approve that legislation where they have a base minimum tax, which probably isn't going to happen. But the fact is that a lot of the environment is turning decidedly negative for stocks. Okay, you've got higher taxes on the way. President Biden isn't going to get his 28% that he wants on corporate income taxes from the 21% that they lowered it to in 2017. But he will get something. It will go up from 21%. A lot of that big tax cut that we saw in 2017 was the big impetus really for for the earnings bonanza that we had over the last couple of years that really drove stocks higher, right? So corporate income taxes are going up a little bit. That's obviously going to take some earnings off the table for stocks. The interest rate environment, another one of the biggest factors really over the last year and a couple of years, but more over the last year was those rock bottom interest rates, right? All that stimulus money being pushed into the economy through the pandemic. And that's now coming off, right? The Fed has actually started to talk about tapering its $120 billion each month that it's pushing into the economy. And, once that goes down, then obviously they're going to start talking about raising rates as well. Won't be within a year or two before they start raising rates, but it is on the table. And, that's the important point here is that environment that has helped stocks so much over the last couple of years is now starting to be a negative catalyst on the markets. So, with just where stocks are right now, as far as valuations, all of that hitting against them, then it's natural to start thinking about a crash, natural to start thinking about corrections and things like that. But like we saw with that quote, a lot of people are going to start buying protection against their portfolios. They're going to start buying puts. They're going to start doing, maybe selling other options, things like that, or just outright selling stocks to get out from, to avoid that big sell-off in stocks and a potential crash. And like we saw, that's a lot of times, more often than not, actually, it ends up costing people more money to miss out on those. And I want to share with you some data that I pulled and put together. And let's go here. So this is data from the data itself. Okay, shows the date on the far left column, S&P 500 level there, and I've got that all the way from 1928, because I wanted to look at the last four big crashes, not including last year's crash. Obviously, that was a little bit more, obviously the pandemic driven. It wasn't necessarily a typical crash that we see. So I wanted to study the four biggest crashes here: 1929, 1987, 2000, and 2007. Okay, four of the biggest stock market crashes in history, and really see, what would happen if somebody had just started investing, at the very height of those crashes. So kind of a worst case scenario, right? Where you just start investing in the market crashes, some of the returns building up to those crashes, as well as if you were already invested in the market and how you would have done. So I took data from, Robert Shiller puts out his CAPE, his cyclically adjusted price to earnings ratio. He puts out the S&P 500 data on that, totally available, free to download. Some great data there that he follows. So I downloaded that, and then you can see that I kind of just put the numbers together. So if you were investing $100 a month, every month, and this column's for the 1929. So here I've got the peak in 1929 in September 1929. If you started investing that month, the month before the big crash in stocks, the big crash started, put $100 a month every month in there, then over the next 30 years, you would have had invested $36,000, okay, and you would have had $138,000 at the end of 30 years. So that's a pretty darn good return, even considering you were investing for, what was probably the worst period of the American stock market. Okay, the S&P 500, the stock market reached its peak in early October of 1929. Didn't actually get back to that level for 25 years. Okay, and that's just an amazing statistic to think about. A lot of the more recent crashes, 2000, 2007, even especially last year, you think about those, and the markets recovered that peak, those peak levels within, I think it was like a decade, or less for the 2000, 2007. It was a few years. Last year, it was up, within a few months. Right, so these last couple of crashes have actually been very mild in comparison. 1929, it took 25 years for the market to get back up to that level, up to that high level. But if you were investing all through that $100 a month, you would have actually had a pretty damn good nest egg after 30 years, $138,000 from investing just 36,000. And it's like that for all four of these, really. If you started investing the month of the crash in 1987, you started investing $100 a month for the next 30 years, and you would still have $120,000 over that period, saved up over those 30 years. And of course, if you save more than $100 a month, you would have had exponentially or multiples more on that. But, you just think about that kind of a return, investing $36,000 during what's, one of the worst crashes, the worst single day crash, in fact, in American stock market history. 2000, you'd still have, for 2000, I just did the 20 years, since obviously we don't have a whole lot of data on that. So 20 years, you would have invested 24,000, would have had 57,000 at the end of that period. On the 2007 crash, or it was the 2008 crash, but stocks actually started falling in October of 2007. They started falling in October 2007, really crashed bad later in 2008. But if you just started investing in 2007 there, just before the crash, and for the next, 167 months, right? $100 a month, you would have had $41,000 at the end of that period. So pretty much 2007 to today's date. So still very good returns, even though you're investing on those worst dates. And what's even more important here is that I want to show you is the last 2 years before the crash. Tend to be the best returns. It's really when the enthusiasm, the exuberance tends to really take stocks to new highs. So if you look at just the returns over the 2 years before each crash, you see, okay, so 1929, stocks did 87% in the 2 years before the crash. 87 is 71%, 46% in 2000, and 2 years before 2007, 24%, which, obviously much lower than those others, but still pretty darn good for two-year stock return. But imagine that, if in 1929 so 2 years before that, if in 1927 or 1985, you were, seeing that stocks were undeniably expensive, just like they are now. Stocks were expensive. The interest rate is coming off, becoming more unfavorable, things like that. So things are definitely working against stocks 2 years out ahead of the crash. And you would have pulled back or, covered your portfolio or sold stocks or something like that, you would have missed out on 87% return. So even though stocks did sell off about 80% from the height of 1929 until their lows, it wouldn't have made a difference because you would have missed out on all of that anyway. It's 1987. If you would have pulled out in 1985 or started covering your portfolio, you would have missed out on 71% returns. And yeah, even though stocks fell, I think something like 23% on that one day in October of 1987, you still would have been worse off by trying to time the market, by trying to time that correction or watch for it if you would have come out, 2 years ahead of that. So some really kind of sobering statistics on why it doesn't necessarily pay to try to get out of the market before a crash or try to time that crash or something like that. And I want to, one more idea here that I wanted to cover, because a lot of you will say, okay, you know what? Yeah, it's bad enough that you start investing right at the crash, but you don't have anything to lose anyway. So if you started investing September of 1929, then yeah, those initial couple of months investments would have really fallen hard, and you would have lost a lot of money there. But it was only a couple $100. So you would actually be gaining more on those, on those subsequent months, subsequent years where you were investing at the lows. Well, what happens if you were already in the market? You already had a good sizable chunk in your nest egg in the market, and then you hit a crash. Wouldn't it be better there to get out and save your money there? But even on this data that I pulled, so 5 years prior, if you had started investing 5 years prior to each one of these crashes, 1929, 87, 2000, and 2007, so you've got a pretty decent nest egg already built up, and you get hurt obviously much more on a crash. Even if you would started investing at that point and then same $100 a month all the way through 30 years there, you would still have $85,000 through the 30 years from 5 years prior to 1929 to the 25 years after that on that same $36,000 investment. So, still undeniably good here. 110,000 for the 5 years prior to 1987. So if you would have started investing in 1982, started investing $100 a month, 5 years there before the crash, and invested all the way through 30 years, you'd still have $110,000, which is pretty darn good return on a $36,000 total investment, over that period, even though it was one of the worst crashes in American history. So I just kind of want to stress that, and we'll talk about some different strategies, that you can still use, like rebalancing, like having a cash cushion, having, different assets that can still, you still can use in light of this data, in light of this reality that it really doesn't pay to try to time the markets. But the simple fact is that for a lot of people out there that, maybe you're just better off with a stress-free strategy where you just invest whatever you can each and every month, and just, don't even worry about stocks. Don't even worry about a stock market crash, because over the long term, stocks do go up. They do rebound to their peaks, and, and you're going to be better off for it. Now, that said, I rebalance my portfolio regularly, usually once every year or two. So I'll sell some of the stock sectors, the stocks in sectors that have done really well. For example, towards the end of last year, tech stocks, technology stocks were up 44% last year. And that's just the general sector. That's just the overall sector. That's not even including a lot of these growth stocks, the meme stocks and things like that have had doubled or tripled or even more last year. But at the end of last year, you could see kind of the economic writing on the wall where interest rates were going to start going up. The economy was rebounding. We were seeing more hints of inflation. And so I did rebalance out of tech stocks, out of a lot of those growth and momentum themes into financials, into energy, industrials, materials, things like that. And it shows in our 2021 Bowtie Nation portfolio that's up 35% so far this year, beating the S&P 500 by 25%, because we did start to rebalance into some of those other sectors. So kind of a contrarian idea, right? And for those of you, contrarian investing is just basically just looking at, what hasn't worked, over the past year, over the past few months, what the market is kind of down on, and rebalancing into that, okay? So looking at what the market doesn't like, and buying that as a value play, right? So we kind of took that shift last year. You can also rebalance from stocks into real estate, into bonds, into some of these other investments. Always a good idea to just have that kind of broader diversification. You can also have just a general small cash cushion, right? I wouldn't recommend having more than 20 or 25% of your money in cash, waiting for that stock market crash, right? Because as we've seen, that cash isn't earning anything, and it could be you could be losing out on a lot of money. If you had 20, 25%, 30% in cash over these 2 years before 1929, before that crash, you would have missed out on 80%, 87% return on that versus the stock investor. So generally, I like to have even when the market is down, I like to have at least maybe a 5% cash cushion, just something to take advantage of different individual stocks that I see in the market. But when the market does start getting a little expensive, and the environment starts moving against the market like we're seeing now, then I might jump that up to 15 or 20% cash cushion. And that's not for everyone. Obviously, for myself, since I do run my own business and that has cash needs every once in a while, then I generally have less risk in stocks. Okay, so I'll have more cash and more bonds, just because the real growth in my wealth, the real growth in my portfolio, my overall net worth is in that business, right? It's not necessarily in these huge returns in stocks or anything like that. So I need less risk in my portfolio versus all the risks that I have in a business and that kind of thing. Generally for most investors, I would say probably 10-15% cash cushion would be more than enough. That's going to give you the opportunity to buy into stocks if they do fall lower, to take advantage of individual stocks when they fall lower, but still not miss out on the returns in the market from not timing the market really. So just some food for that thought there. Kind of a short a shorter topic this week, just something that I wanted everybody to look at, because there is that sense that you have to be timing the market, that the market is kind of tenable right now, and that things are lining up against it, and returns are going to be subpar over the next year or even more. So there is that sense that people want to be trying to get out or trying to time the crash or something like that. And it's not necessarily the best thing to do. Okay, not only for your sanity, right? It's just creating that stress-free strategy that doesn't depend on being able to get in and out before a crash, but just on a returns basis as well. So now I want to open it up to question and answer here. Favorite part of the week, really just kind of talking back and forth with you, seeing your questions and being able to answer some of those. So I'm going to scroll back up